Okay, so this is for the subject monetary policy and central banking. The specific topic for this video is bank examination. Here we have an article from investopedia.com. So let's begin with the definition of bank examination. So it's an evaluation of the financial health and resilience of a bank. Essentially, how the bank or whether the bank is capable of surviving any economic situation that may arise in the near future or in the future to come. Okay. Bank examinations are primarily concerned with the strength of the bank's balance sheet. So in the balance sheet, there we can find the assets. So all the properties owned by the bank, and then we have the liabilities or the debt or borrowings. It's actually the deposits of, the depositors, savings accounts, checking accounts. Those are liabilities of the bank. And then we also have the equity or part of the bank that is funded by its owners. Okay. However, they also include a review of its regulatory compliance and internal control. So all banks are under the authority of or under the regulation and supervision of the BSP, Bangko Sentral ng Pilipinas, and of course the regulatory authority is the Monetary Board of the BSP. So there is regulatory compliance and then internal controls to ensure the safety of the assets, the functionality of the operations of the bank. Okay. In the US, examinations of national banks are carried out by the Office of the Controller of the Currency. I'm not sure if we have a separate department here, but essentially it's going to be someone from the BSP, right, from the central bank. Examinations of state-chartered banks carried out by the FDIC. Here in the Philippines, we do have PDIC. Examination for bank holding companies, examinations are carried out by the Federal Reserve. Okay. Bank examinations, evaluations of the financial health of banks, whether their financial composition or financial consideration could support their operations, their stability, and their long-term survival as a business or as an institution. Conducted by regulatory and government institutions. It's for banks, since they are corporations, they are also under the supervision of the SEC, Securities and Exchange Commission. And then for publicly listed banks, those banks whose shares are being traded, so they are under the supervision and regulation of the PSE as well, Philippine Stock Exchange, okay, on top of the BSP, Monetary Board, okay. Bank examinations use a 6-part analysis designed to measure the quantitative financials and qualitative health of the banks in question. So how does bank examinations work? The process of conducting bank examinations is based on the so-called CAMELS rating system, acronym outlining the 6 major areas of examination. So we have capital adequacy. Do they have enough, capital on hand to be used in their operations? Asset quality. So the composition of their assets is not just cash. There would be PPE, of course, property, plant, and equipment. Normally includes, the buildings, the lands, and then they also have short-term investments. And then, of course, they have long-term investments. And those investments should be diversified. They should be spread across, different industries, and there is a limit to how much they can invest in a particular company. Okay. Again, this spread across different companies, spread across different industries to minimize the risk and to diversify their investments. Thirdly is the management. The BSP has to ensure that the management are competent and that they know what they're doing. They have proper plans in place for the, operation execution of the bank. Okay. And then earnings, profitability. Are they earning? Are they incurring losses? And then liquidity, again, liquidity is the convertibility of their assets into cash to support their daily needs or their operational needs. Okay. And then we have sensitivity to systemic risk. How do they adapt, or how do they cope with changing situations in the market? Okay, so in the case of the pandemic, how well did they adjust to the current situation? Okay, there are certain banks that, during the pandemic, they have allowed the opening of bank accounts online by just submitting one document, I think, or one IDs. They essentially made it much easier for people to open bank accounts and to avail of their services, which they weren't doing before the pandemic hit. Okay. Based on these 6 characteristics, banks are assigned a rating on a scale of 1 to 5. Each bank will receive a separate rating for each category, along with an overall result. A score of 1 indicates a very positive result. So, just like college rating we have, right? Uno is the highest, cinco is the lowest, while 5 indicates very weak result. If a bank scores 4 or 5 on its overall review, it will be placed on a special watch list. Okay, they have to be, observed further and ensure that their situation gets better. Okay, hindi naman sila papabayaan. Okay, they would not be ignored. In a way, they would be provided with consultancy, advisorship, something like that. Okay. The capital adequacy criteria relates to the bank's Tier 1 and Tier 2 capital reserve requirements, and of course the ratios, and whether these funds are sufficient to support its banking operations under conditions of stress. Okay, not their ordinary operations, but under stress. Okay, conditions of stress. The pandemic is a kind of a stress for most industries, including banks, right? Likewise, the asset quality condition relates to questions such as whether the bank's loan portfolio is sufficiently diversified and whether its loss provisions are in line with industry norms. Okay. As we know, banks are involved in, lending money to businesses or to individuals, and there would be times that some of the people that they have lent money to would not be able to repay the loans, right? So they have the so-called non-performing loans. And there is an industry average that is acceptable. Okay, all banks are experiencing it, and in a way they cannot fully eliminate it. So there's an acceptable percentage for it. And if a bank is within the industry norm, the industry average, then it's okay. They're doing good already. But if they go higher, because these are non-performing loans, going to result into losses for the bank. So they have to make sure, probably they're going to be more strict with their requirements in scrutinizing the borrowers so that they're, what do you call this? They would have, NPLs that are within the industry norms. So whenever they go beyond the industry norms, they have to do something to bring it down back to the industry norm. Okay. With regard to the management criteria, regulators will want to ensure that the bank's executive team, management, have a clear operational strategy and understanding of their organization's unique risks. Okay, as well as a robust protocol for ensuring legal and regulatory compliance. Normally, payment of taxes, business registration, compliance with SEC, PSE, BSP, of course. In regard to the earnings criteria, regulators will examine the earnings quality of the bank, profitability, how much profit have they, generated for a particular period, and whether those earnings appear stable enough to support the bank should it come under strain. Stability over the last 5 years, their profit percentage is close to each other. The figures are close to each other. It does not fluctuate very much. So in a way, it's a steady trend. Okay, from year to year. Lastly, the liquidity and sensitivity criteria pertain to the bank's level of stability in the face of potential shocks to the financial system, or, something unexpected like the pandemic. Regarding liquidity, regulators will measure the bank's ability to meet its financial obligations. Normally, for liquidity, the bank is imposing an acceptable level of current ratio asset test, our quick ratio or cash ratio. Essentially, asset test and quick ratio, it's the same. Cash ratio would only involve cash. Okay. Wait, let's go over each of these. Ability to meet its financial obligations, liquidity test. Current ratio is the current assets divided by the current liabilities of the bank or the institution. Essentially, what it means is how much current assets does the company have, which they could use to pay off their current liabilities, their current debts. Okay. And then for the asset test, it's asset test or quick ratio. The compositions include cash because they're readily available to pay off the current liabilities. And then we have accounts receivable because they only have to collect them for them to be turned into cash. And then once it's cash, again, they could use it to pay off their current liabilities. And then the last one is what they call it, short-term investments. Short-term investments that could be converted into cash easily, okay, without much complications. Okay, so that's quick ratio. Quick assets, we call them quick assets. The cash, receivables, and then the short-term investments. Okay, and then divide the total of that with the current liabilities, and that would show how much ability the bank has to pay off their current liabilities with their quick assets. Okay, and then cash ratio, this would be cash alone divided by the current liabilities. Okay, because cash is already there, already available to pay off the short-term debts. Current liabilities are short-term debts payable within 1 year, and then you have your non-current liabilities, which are payable in the long term. Okay. There's another ratio for solvency. Solvency is long-term, right? Liquidity is short-term, ability of the bank to pay off its short-term obligations with its current assets, or not. Current assets are not really short-term assets, but readily available for operations, right? And then you have your solvency, which is ability of the business to pay off its long-term obligations with majority of its assets. Okay. When evaluating the bank's sensitivity to systemic risk, regulators will often use complex financial models that simulate the bank's financial performance. Financial performance is the income statement, revenue minus expenses. You have your net income. It shows it shows the profitability of the business, how much money they are earning, how much are they spending, and then the bottom line, net profit. Subject to various potential adverse changes in financial markets. So if you know sensitivity analysis, essentially they're trying to simulate scenarios like, let's say, if a certain event happens, how would it affect the revenue of the business? Would it decrease? If so, by how much? And then the same situation, would it affect the cost or expenses of the company? If so, by how much? Okay, and then the net effect on the net income. Okay, and then of course they would create various scenarios, right? And then they would see how each scenario would affect their financial performance. Okay, and then examples of such changes include rising interest rates. This one is being regulated by the BSP. If the BSP says that we're increasing the interest rate, so financial institutions would have to follow that and also increase their interest rates. And then if the BSP lowers the interest rates, then all banks would have to follow as well. But of course, how would that affect their financial performance? Of course, increasing interest rates would probably result to lower volume of borrowings or transactions, right? Then decreasing interest rates would probably result to more people borrowing money from the banks and larger volume of transactions for those borrowings. Okay. Increased loan default rate. So during the pandemic, because of the lockdown, businesses have temporarily ceased operations. Others have, permanently ceased operations. So the banks would probably have some of their clients included in that group. Okay, so they would have loan default rates. Essentially, over the past few months, the BSP did report that the NPLs, non-performing loans of the banks, have increased, compared to pre-pandemic. Okay. Declines in the value of investment holdings. If you've noticed, of course, the PSE, the overall value and the tradings of the various companies traded in the PSE, they fluctuated so much during the pandemic, but at the initial stage of the pandemic, everything really went down. So if if the banks have investments in stocks, then the valuation of those investments would have gone down as well during that period. But of course, during it's been more than 1 year already, and we've seen ups and downs. Normally, when the lockdowns are eased, most places have been placed in GCQ rather than MCQ. Then there has been increases in the valuation of the stocks. Okay, there are increases in the market prices, but when Manila was announced to be in MCQ last month, the stock prices have gone down again. Okay, and then now that it's on GCQ again, it's probably going to go up. Okay. Then lastly, we have here defaults by derivative counterparties. Okay. I think I mentioned this before already. The derivatives, it's like gambling. Okay, you're projecting that a certain situation would occur in the future, and you have someone to bet with, and then if you are right, then you're going to have a gain. If you are wrong, then you're going to have a loss, and the other party would have the gain. Okay, something like that. Maybe later we'll have more examples for derivative instruments. Okay, real world example of a bank examination. What can you do, okay, with the information? Okay, Dana is an investor who regularly reviews the examination results of major banks. As part of his investment screening process, he reads through the most recent bank examination for a national bank called XYZ Financial. In summarizing the results from the examination, Dana notes that XYZ received a CAMEL score of 5 in the asset quality category. Intrigued, he dug deeper to discover that XYZ's loan portfolio is highly concentrated in a particular sector, which is currently facing disruption from new entrants. Given the uncertainty in that industry sector, regulators raised concerns as to whether XYZ's debtors may be unable to repay their debts. In that scenario, XYZ could face higher than normal loss rates in its portfolio, calling into question its profitability, liquidity, and capital reserves. With this information in hand, Dana decides to avoid XYZ Financial until there is less uncertainty surrounding the quality of the loan portfolio. But, okay, although it did say here that it's a real-world example, I don't think this is currently happening, because normally the BSP would just report probably a rating of the banks, but they would not exactly provide further details. Maybe there are, but it's only provided to certain individuals like regulators, financial analysts, or something. But normally, if you would remember, if the BSP announces that a certain bank is facing problems, they do make reports on that, but they would never name the particular bank or financial institution involved, because they're trying to protect it as well. Because putting out a negative news about a certain institution could, of course, affect and damage their operations. Maybe their depositors would pull out their money, which would, worsen the situation. So they would not name the particular institution, but they would say that, they're trying, there are, resolutions in place to turn the situation around. But, it's just as part of their reporting process, they do provide the report, but it's anonymous, okay? We don't know which bank it is, okay? But normally banks have, financial ratings or some sort of ratings available for them. And of course, there are also reports on how much profit they have earned during the past few years, or how much total assets do they have in the past few years, or transaction volumes. There are, what do you call that, rankings of financial institutions here in the Philippines. Which one is the biggest bank in terms of net assets, or of profits? Okay, there are things like that, and that in a way would probably help investors in deciding where to put their money. But, or normally businesses also put their investments into other companies, and some of those companies could be banks as well. Okay, so there are things like that. Normally, the point of the bank examination is for the BSP to ensure that the financial system is working properly, that there are no problems that could disrupt the whole system. Because if one bank is having issues, okay, although it might be a small bank, the impact would still be on a large scale. Many people would still be affected, especially if the number of depositors that they have is high, the number of borrowers is high. So it could still affect, could cause some sort of disruption in the financial system. Okay, so it's important that the BSP does conduct bank examinations to ensure that these banks are complying with the regulations. Okay, so that's it for this one. We'll continue on with different more information about bank examination, BSP regulations, and BSP supervision. Right? So that's it for this one. Thanks and bye.